Okay, happy Friday. It's Friday already, everybody. We are with our ALC meeting, virtual today over Zoom. We have a special guest introduced in a second. We are the four locations, the South Bay office, the Long Beach Coastal office, the Palos Verdes office, and the Valley Luxury office. And super excited to introduce today's special guest, Marc King. Marc King, if you know him or of him, been with KW. If I'm wrong, you can correct me afterwards. Since 2003, climbed through the roles, team leader, maps coach, area director, regional director, division leader, director of growth, and of course, our company's president, I think best of all times. And he was appointed president of Keller Williams, I think in 21,
Yep.
right?
Yep.
And then you made a big change last year in 2024, and now you're running some big stuff. And I was privileged to be in your wealth seminar a few months ago, and it was mind-blowing. And I thank you for your time over here to talk to our top agents, top leadership in the offices, and take it from there and tell us more. Thank you, Marc.
I'm super excited. Number one, I got to say, I've seen all your market centers on reports for years, and I know what you guys have done to improve things. So congratulations to all leadership teams. It's not always the easiest state to deal with, California, when we deal with on the national scene. So thank you so much. I thought what we'd do is, number one, if you have any questions, throw them in the chat as we go. There are no bad questions. But I wanted to kind of level set today around what's actually going on financially out there. There's a lot of political tension. There's a lot, the big, beautiful bill. How does this affect our taxes? I have nerded out on reading probably 1,000 pages of tax code. No one should ever do that. But it's something I love, I'm passionate about. And oftentimes what we do as real estate agents is we tend to project that other people have more money than we do. They're somehow getting ahead faster than we are. We see someone online or we see a car next to us, and we assume, we overestimate what people in our lives' net worth is, or their ability to buy a home, and we underestimate what our net worth is. We overestimate what other people make. We underestimate what we make. And so what I thought I'd do is just bring some data. I love just fact-driven conversations, maybe think about it a little bit differently. But having been a top agent, having been a brokerage leader and ultimately a leader in Keller Williams, I wanted to just kind of share some of the data that would help us all in this market, if that's okay. But any questions, fine. I love ALCs. You're the people that are going to be most impacted by this data in this conversation. So we'll just jump in, interrupt me anytime you want. And if you want to show off your mama mentality anytime, Emilio, just do that. All right. Is this how it's supposed to go? Oh, it's way back here. Okay, got it. All right, so let's jump in. Let's level set. Where are you? I'd like to start off today by saying that, a lot of people would ask me about, what's it like to be an executive at a large company like Keller Williams, et cetera. And my simple response is, what I learned working with Gary and several other amazing leaders like Wendy in your office there, Minnie, what I learned is you have to be the CEO of you first before you can hope to be the CEO of anything else. You have to be the leader of yourself first. And a lot of times, unfortunately, we put people up on pedestals only to watch them fall because they don't have their own house in order. So that's the conversation of today. You are the CEO of You Inc., and there is no cavalry coming, right? My wife and I do a lot of marriage conversations, a lot of work with couples. And the number one cause of divorce is money fights, money problems. It's misalignment on money. So if you think about it, if I'm the CEO of Marc Inc. and I meet the love of my life, the CEO of Kristen Inc., what are the chances both of us are going to be perfectly aligned on all things, including money, when we merge and acquire each other's businesses, right? And our marriage, not to make this sound cold, but your marriage is kind of a business relationship as well. And if we can dissect what causes challenges in our relationships, then we can hope to avoid them. So let's jump in. What I have on the top here is, this is a recent study. If you're curious, JP Morgan just put out the most comprehensive study on retirement I think that's ever been done. And it's fascinating what they found. I'll share it with you, but you can go Google JP Morgan retirement study. You can pull it down. There's 50 something slides. You can go learn all you want about the reality of retiring. So let's jump in. This is qualified retirement funds, but if you had to play along at home and guess, what percentage of Americans have less than $10,000 in their retirement? What percentage of Americans? But you can see right here, it's 58.4%, almost 60% of us. These are all working adults and all retirees. So everyone who works starting at the age of 18 till the oldest retiree in the country, this is all of us, 60% of us have less than $10,000 for retirement. That's a problem because we live in a society where we're going to need funds to retire someday, or we're going to work for the rest of our life. Ironically, in a recent poll, 60% of Americans said their retirement plan was winning the lottery. Said differently, they have no hope and no plan. So their only out is this dream they're going to somehow be that 1 in 20 million person that wins the lottery. So that shows up in these studies. Then under 100,000, so 10,000 to 100,000, that's an additional 20.5%. So almost 80% of Americans have less than $100,000 in retirement. Let me just let that sink in, 80%. Let's keep going. Another 13.9% have between $100,000 and $500,000 in their retirement. So now we are at 93%, almost 94% of the country that has less than $500,000 in retirement. So if you're one of those, if you're one of those people that has been influenced to believe everybody has these golden retirement plans and everybody's in better shape than you, this is just kind of figuring out where are we, what group are we in. What I like to do every 3 months really, but especially at the midpoint of the year where we are now, let's do a check-in. How did the first half go? What are we planning for the next half? This is also, I think, a historical time because whatever bill is passed by the Senate, I think it's coming in the next week, it will dramatically impact you and your finances, and probably at a more comprehensive level than ever before. So in 1986 and in 2018 were the two biggest tax reforms in U.S. history, and this is about to be bigger than both of those. So you got to know enough to be dangerous. You got to surround yourself with the right people. You got to be paying attention to this conversation because it will impact you. It'll impact your clients, right? Then we go on. 500,000 to 1 million is 4% of the population. 1 million to 5 million, 3.1%, and over 5 million, 0.1%. So as we think about the state of retirement, first thing to check in on is where are you? Where would you like to be? Right? So that's number one. Number two is understand your client base will have this same makeup. They'll have the same makeup. So just understand that piece of it. But now, how do we dig into the different age brackets? How do we understand where we should be in life? All those good things. I've got some net worth numbers for you down here. But before we go on, any questions about this top section here and qualified retirement funds? Isn't this exciting? Or is this the most boring conversation ever? It could be that this is the secret to building wealth. People always ask me, teach me something about real estate. And I love real estate. And I'd love to teach you something about real estate. And real estate is just how we make our money. What we do with our money will determine if we live the life that we design. So that's why I so much focus on this. But any questions, any comments here?
Yeah. These numbers are just based on liquid money, or is it also in assets?
Good question. So this is just qualified retirement. So, to strip this down, and one of the things I like to do is take for some reason in finance, people use these big words and confusing things, and I just, make it stupid simple. And all this means is any kind of retirement you have that has rules around it. So a Roth, a 401k, a IRA, all those things are just how you hold your retirement money. But this is all the money that we actually have in a qualified retirement plan. Something that we get a tax break to do, tax defer, or a Roth, which is no tax on growth, whatever that is. These are just what we call qualified retirement. This doesn't include any kind of equity in your house. I'll show you that in a second. It doesn't include brokerage accounts. If you've got Robinhood, if you've got other brokerage accounts, it doesn't include Bitcoin or gold or any of those kind of things. This is just what's in a qualified retirement plan. But the reason that it's so important to know these numbers is this is the most tax advantaged way to save money. So I'll give you a perfect example. The best rate of return on any investment guaranteed is a matching 401k from an employer. And yet a very small percentage of us max out our matched retirement. So, you know, at Keller Williams, we were very proud of the fact that our employees at KWRI had some of the best matching in all of corporate America. And so if you were someone at KWRI who made $100,000 a year, we would match up to 6% of your salary, or up to $6,000 for every dollar you put in. So you put in 6,000, we put in 6,000, you've made 100% rate of return immediately. And that is the best, that is the best rate of return you're going to get. The reason that this is so troubling is what it shows you is very few people, the majority of us in America, have some kind of retirement plan at our jobs or matching opportunity, and we're not taking advantage of it. So that's all that top section is. Great question. Good job. What else? We good? All right. Now let's check in. Where are we? Where should we be? All those good things. So what I have is age brackets. So we'll find your age. I have average net worth, and I have median net worth. Net worth is everything you own minus everything you owe. This includes home equity. There should be some ahas in this conversation for us, but this tells us kind of where the average is and where the midpoint is. So averages, I almost don't even look at anymore because they're very skewed. And median is what I use to go by. So half above, half below. The reason that averages don't make any sense to me is I saw on the news that Jeff Bezos is getting married this weekend in Italy. So rock on, Jeff. That's awesome. Now, he's got a lot of celebrity friends out there. If I showed up at his wedding and you took an average net worth of everybody in attendance, it's probably $1 billion. But that means nothing to me and my net worth, right? Because Jeff Bezos skews that number. Kim Kardashian skews that number. Oliver, what's his name? Leonardo DiCaprio just showed up. Not that I'm watching TMZ, but just so you know, they're having this great wedding. Ironically, the wedding will cost more than the prenup. I thought that was funny. Anyway, we'll leave that alone. But let's get into some averages and some medians. Here's a great way. If you want to go win a bar bet with your buddies, here's a great stat for you. Well, forget that. Don't bet. Don't be in bars. Anyway, what do you think the average net worth is per household in America? The average, I mean, it's really hard right now. We're having a hard time getting by. Housing affordability is a real issue. Inflation is a real issue. So what's the average net worth in America per household?
Under 100,000?
Okay, good guess. It's $1.1 million. Now, who just turned off their computer and thinks I'm a quack? I get it. I understand. That's why averages don't matter, because for every one of us, there is a Jeff Bezos times 10,000 of us, but there's a Jeff Bezos that skews the averages. So I know that in the neighborhood I grew up, the net worth is not positive, let alone $1 million. Yet, when you take all the net worth and divide it by households, that's what you get. So it's skewed. So it's really not that important of a number, but it kind of puts into context where we are as a society. The more important number is the median. And even more important than that is based by age. So that's what I'm going to give you now. If you're under the age of 35, your average net worth, everything you own minus everything you owe, is $183,000. Again, not that relevant. The median is $39,000. So half of the adults above 35 and younger are above 39,000, half are below. So we're just starting out in life, right? So we would expect that. Then we go 35 to 44. There's a lot of people on this call in that age bracket. The average is 550, but the median is 135,000. So half of this age cohort has a net worth above 135 and half have a net worth below 135. As we start to mature and we get into our peak earning years, which is really the decade of your 50s, as we get out of debt, which is a huge accelerant to your net worth, we get into the 45 to 54-year-olds. Now, I happen to believe this is the best group on the board because I happen to be in it. My wife is in it. I just think it's the best. Our average is $975,000, but our median is $247,000. So half above 247, half below. 55 to 64, average 1.56 million, median 364,000. And then we get into 65 to 74, 1.79 million, median is 410,000, and then it drops after the age of 75. So 1.4 million and 335,000. Now, for all of you top astute real estate professionals, what aha are you having about the median net worth of all these age groups?
Right.
Buyers are over 44.
Okay, yeah, there's some good ahas there. The housing affordability crisis is under the age of 43 right now. There's a mismatch. There's about 5.5 million of the 7 million buyers sitting on the sidelines that are looking for a first time or first move up home. And those are the homes that are not, they're harder to find. Those are the homes we're competing with BlackRock to buy. Those are the, right? Those are, and there's a reason for that. If you study taxes, you kind of know why we're in that situation. But there's a mismatch in the supply and demand industry, right? Look at the, what's the median price point of a listing in your market area right now?
Probably like 1 million.
And the buyers are not in that price point. The majority of the buyers are less than that in price point. So there's a mismatch. But there's another big aha around the median net worth. So think about it from a real estate perspective. You buy your first home, you know, I bought mine in my 20s, but you buy your first home, you start to build that equity. Over the course of your life, if I showed you the actual equity per age cohort, it would almost line up exactly with our median net worth. Said differently, our net worth right now in America is almost all in our houses. In fact, it's more than in our houses, meaning we have more, our net worth minus our debt doesn't equal up our home equity. So we have our home equities covered other bad decisions, if that makes sense. But if I lined up all the net worth with the home equity, it would be almost the same number. Does that make sense?
Yeah.
Okay. So I believe we're in the noblest profession there is. As a real estate agent, we're helping people build wealth. The number one correlative to building wealth is home ownership. And that's across any group of people in any state. So the faster we can buy a home reasonably, responsibly, the more we're on track to start building wealth. Number one correlative. So as you think about the clients that you're working with, you kind of now know what their net worth is. You kind of now know how to help them build more net worth. And I think as a real estate professional, part of our jobs is to help our clients build net worth, right? Any other thoughts on this? Any other ahas, questions, comments, concerns?
I think it's also a good indicator to show us like where we at, right? As professionals, and understand if we ahead of the game or be, you know, still behind, and then, you know, by understanding those numbers, do a better effort to keep building the wealth for ourselves, which is going to make us a better professionals as well.
That's so key. And all this is a checkpoint. I'm not a fan of comparing ourselves to other people, but in this case, I find most people are doing better than they think they do. In our practice today, we consult a lot of people who don't understand. They're much closer to being financially free than they understand. But I'll tell you, there's another key point here. We are in the business. We have a license to build wealth. Real estate is the most advantaged place you can be to build wealth. I went through the recent tax bill, and I pulled out the 13 most important things for real estate agents to understand. But something before we even get there, there's something really important. Again, I don't know California state law as well as you all do, so you're going to have to talk to your advisors and all of your professionals there. But in order to take advantage of the federal tax law, so it's all the states, you really need to be, you know, set up as an LLC or some kind of corporate entity, elect to be taxed as an S corp, and then pay yourself a W-2. If you do those things, if you're structured that way, then you have the ability to become what's called a real estate professional. And what I've found, and I don't mean any shade, I've taught maybe 10,000 agents this over the last 8 months. There's no shade at real estate agents. It's not just that we don't pay attention to boring detail stuff like tax code. It's that our personalities that attract us to this business Who would be crazy enough to work commission only, where you got to go find your own leads? You got to convince people to sell their number one asset. Who would be crazy enough to do that? These people would be, right? We would be. And so we're unlikely to be the same people who have the mind of an engineer or an accountant that is going to go pick apart every tax saving we possibly can. But one of the things we don't necessarily know en masse is to be a real estate professional. That's an actual IRS designation that your accountant has to check a box on your tax return and put their CPA license up against and testify that you are a real estate professional. You meet the criteria to be a real estate professional. You work at least 750 hours a year in the business of real estate, right? You have material participation. You don't have a W-2 outside of real estate for more than half of your hours. There's tests that you have to meet, and your accountant has to sign off on it. There's less than 3% of us are officially, according to the IRS, real estate professionals. Why does that matter? Because if you understand how accelerated depreciation, cost segregation, all those fancy terms work, before real estate professional status, it's really hard to write off an active income, your sales commissions, etc., against passive losses or accelerated depreciation. So I'll give you a basic boilerplate here in a second. But because you're a real estate professional, you can accelerate depreciation on a rental property, and you can write that off against your active income. So I'll give you a brief example. If everything passes the way that I think it will next week, then you're going to see a tick up in people buying real estate back half of this year. How do we know? Because we just lived this story in 2018. The reason real estate shot up, the reason you can go on YouTube and find Gary Keller or myself or somebody else saying real estate looks like it's going to improve when the rest of the world is saying it's going to fall off a cliff, is because the government gave every tax incentive you could to real estate investors. And in fact, the reason they did that, if you're curious, is the stock market started to get inflated. In fact, if you study the Shiller Index or the Warren Buffett indicator, you'll see that on average, publicly traded companies are about twice the value that they should be. Doesn't mean the stock market's going to crash. Doesn't mean this time is indifferent. But if you add up the entire value of every publicly traded company and compare it to the entire gross domestic product of the United States, Warren Buffett many years ago came up with this indicator and said those should be equal. So you got 30 trillion in GDP, you should have 30 trillion in total value of companies. Well, right now, where do we sit? We got 30 trillion in GDP and we got about 60 trillion total value in companies. So when the economists see more money flowing in, and there's a cause and effect relationship to this, there's a reason why, and they see more money flowing into a certain asset class, they pass different incentives for you to move money into different asset classes. In this case, real estate. So the reason that rents haven't kept up with prices, the reason the 1% rule as an investor doesn't exist anymore, is because you have such big tax advantages for buying rental property. So let's say you made $100,000 in active income and you wanted to quote unquote pay no taxes. Again, talk to your tax strategist, right? Don't just go say, Mark said I don't owe taxes. I don't want to get you in trouble or me in trouble. But if you wanted to write off $100,000 in taxes, then you could go buy a $300,000 rental property, put it into service in 2025 and write off about $100,000 against that. So you write off $100,000 of your passive property, your rental property, against your $100,000 active income and theoretically pay no taxes. Now you've got to set it up right. You've got to collect receipts correct. You got to document. You need to walk through this. It's not something for the faint of heart. You actually have to do something for this. But it's an example of how, as real estate investors, as real estate agents, we have the ability to take advantage of tax breaks. So that's why I'm always shocked when the percentage of real estate agents, what percentage of real estate agents do you think own rental property outside primary residence? What do you think?
Less than 20%.
20%. So
9%, right? 9%. You're exactly right. It's a very small percentage of this. So think about this. We're on the front lines of the best real estate deals on the planet. If we know how to value a property, which is the singular most important thing to clients, according to all the NAR studies, if we know how to value a property, then every day we're on the front lines of the best real estate deals on the planet. and yet only 9% of us buy that rental real estate. So step number one is we got to get our income up, we got to get our net worth up, and then we got to start investing in the one thing we're supposed to know better than anything else, because then it unlocks and explodes your tax breaks, your incentives, etc. Sound good? Any other questions, comments, concerns, thoughts? Is this valuable?
Yes.
What kind of like articles or where do you get more information regarding, you talked about, like, it's something I kind of want to share to my clients,
Yeah.
about the, everything you just talked about, like, where do you get all that info?
Yeah, you can be a nerd like me and study this way too much. Can I share my screen? Minnie, I'll share some resources. Couple things. Number one is you can go to ChatGPT and type in what are the 10 most relevant suggested tax bill items for real estate agents, real estate professionals, or real estate customers, and it'll get really close to this. But I'll give you a short list to go study. What I want you to do though is, and here's the habit I'm trying to build with real estate professionals, is that they spend a little bit of time studying this stuff so that they can be equipped. Imagine how your customers are going to feel if you know way more about this than all of your competitors, right? So let me find some notes on this as we go, and then I'll share my screen and give you some other stuff. I totally nerded out. So number one thing I would go study is section 168. That's the bonus depreciation. So by a show of hands, how many of y'all have heard the term accelerated depreciation or cost segregation? Anybody?
Yeah.
Okay.
Yeah.
Yeah. All you have to do is go to TikTok or YouTube and you'll see all kinds of bad information on this. So it's important that you go study this as well. But this is the secret to accelerating your reduction of taxes each year. So go look into that one. Section 179, we should know that one. That's been dubbed the realtor rule. You may not know it as section 179. You might know it as the 6,000-pound vehicle rule, right? And unfortunately, this is the number one piece of advice that a tax strategist gives a real estate agent. So if I could implore you to do anything, it would be up your game in terms of the professionals you use to help you build wealth. Find the best tax strategist there is. But right now, if you need to invest in your business, it is going to be a great time at the end of this year to go invest in your business. The limits have been raised. You can write off 100% of a new vehicle if you need to. You can write off 100% of some equipment for your business, whatever the case is. So that's section 179. A huge one, especially depending on where you are in California, is go Google opportunity zones. Opportunity zones are usually, now this came from the USDA and it was meant to kind of resurrect bad areas. But what happens, and I'll give you the real world scenario, opportunity zones are simply blighted areas that we're trying to draw investment. So the local government, state government, national government gives you incentives to go invest in a tougher part of town, let's say, and to make it better. It sounds great on the surface. When people draw the map for opportunity zones, they're not going out neighborhood by neighborhood. They're looking at a map and they're circling an area. The reason I bring this up, every opportunity zone I have seen has really good real estate deals in them. My lake house is in Missouri. I have, probably the median price point in this area is well over $1 million. And part of the end of my neighborhood is in an opportunity zone. So you will find great real estate investments for yourself or for others in opportunity zones. But the benefits of opportunity zone investing is huge. The reason this also matters, if passed the way it's worded right now, is for the first time, y'all know what a 1031 exchange is, right? You sell a property, you put the money, as long as the property is, they used to say like kind, now it's almost any kind, but it has to be a higher price point, right? So think of what if you could sell a business or sell your stocks or sell anything that you would normally pay capital gains on, but avoid capital gains by investing in real estate. That's coming. So if you work with clients who are investors or clients who own businesses or clients who have lots of stocks, whatever the case is, there's going to be a huge opportunity to kind of mix some of these tax breaks together. For example, I just sold a business, right? Need to do something with that money. I don't want to pay 20% federal, 5% state capital gains tax, 25%. So I can go take that money I made from business and I can go buy a great rental real estate property in an opportunity zone, get even more tax breaks, and then I'll tie in some others to this as well. But if you understand this at a high level, right now is when people are going to absolutely go make, I think in the next 3 years, you're going to build all the wealth you need for the rest of your life if you pay attention to this conversation, right? QBI, section 199. QBI is qualified business income. It's going from 20% to 23%. Most real estate agents don't even know what this is, but since 2018, hopefully you haven't done your own taxes because you might have missed this, but you get to write off the first 20% of profit in your business. Now that number is going to 23%. And I will just say this, I've said this to everybody, I don't get involved in the politics of all this stuff and the right and the left and all that. But I will tell you, I've heard some rhetoric that this tax bill is only for the wealthy. It is absolutely not. I have devoured this. In fact, all of these things I've just given you have an income limit. So if you make over $550,000 a year net, you can't take advantage of some of these things. If you make more than $5 million a year profit, you don't get QBI or 23% of your profit tax free. So, you know, it's just disingenuous to say these are tax breaks for the wealthy, but we can spin that. And here's what I would tell you. About half of the country pays net taxes to the federal government. About half the country does not pay net taxes. In other words, the tax credits offset whatever they pay in taxes. That shouldn't be controversial. It's just a stat. It's just math. So every time there's a tax break, it only is for people who pay taxes. So by definition, every tax break is for the wealthy. Does that make sense? Every tax hike is only affecting people who pay taxes. So be careful what you listen to, study it for yourself before you make any of those judgments. The SALT, you need to know what SALT stands for, state and local tax. That's the big fight right now. We'll see how that goes. But in essence, you know, California has one of the highest state taxes in the country. And I understand it could be going up. So what SALT stands for is state and local tax. So the proposal is, let's say you make $250,000 in California that you're paying taxes on, and you've got to pay 13%, and it's a stair-step scale. But let's say on that, you're going to end up paying somewhere around $25,000, okay, to the state of California. Now, what SALT says and what the bill says is we should deduct that $25,000 from your federal tax bill. We want that. If you live in California, you want that, right? You want to be able to deduct. We should be able to already deduct other taxes against our federal taxes, but we can't all the time. If you make too much money, you can't anyway. But what we should be doing, we should want that. The challenge is, if you don't agree with the policies of California versus New York versus Texas or wherever the case is, you could argue that your federal taxes are subsidizing behavior you don't like. So that's the fight over SALT. That's all that means. A big one for you to know is the standard deductions getting raised. Married filed jointly is going to go up to $32,600. And that's where 99% of your clients are going to be. They're just going to take a standard deduction. It's probably where 99% of you are. We're not going to itemize all of our receipts. We're just going to take the standard deduction. So that's almost double, by the way, since 2019 of what we get to write off. So that's a big deal. Another big deal is this $1,000 for every child born going straight into a retirement account. So if you had to guess, if you have a child today and the government gives you a $1,000 tax credit that goes straight into a retirement account, if it grows at 10%, by the time they're 75 years old, do you know how much money that is? Anybody? Anybody?
How much? 2 million? Yes.
Yeah, about $1.2 million. Now, it won't buy the same thing 1.2 million does today, but we can do the math and back into it. It's almost equivalent to $400,000 of today's money, right? Is what it would be. But said differently, and there's rules around it. You can't take it out. You can't do different things. But in other words, as a taxpayer, we would be subsidizing $1,000 for every child to get them started off right and get them investing for their future, for their retirement. I believe that, you know, if you read the tea leaves, that's partially because Social Security is in trouble, right? There's other challenges there. So that's a big deal. Child tax credits going to 2,500. This is going to be a little crude. I apologize, but basically a lot of this bill says we need to make more babies. We would like to do it, you know, the right way, but we need to go make more babies. So our population isn't where it should be. Yeah, I'm sorry, it's 1.75 million. It's 75. You were right, closer to 2 million. So those would be the highlights. That's what I would go study. Just go to ChatGPT for that. I will share with you real quick. This is the other thing I like to study. Okay, y'all, can you see my screen there?
Yeah.
Okay. Let me see if this populates. This is the JP Morgan Retirement Guide to Retirement that was just published in 2025. Now, there is amazing information here. I'll give you a couple highlights and then I'll leave it alone, let you go study it. I'll begin with the end in mind. If you want to know what all the limits are for all of your retirement plan contributions, it's on slide 54 here. And these are important to understand. If I quizzed 100 accountants, they wouldn't know this by heart. So you just became smarter than every accountant because you have this tool, right? But here's what this study said. We all think when we do retirement planning, and I'm around a lot of retirement planners, we tend to add some number like 3% inflation. And we plan our retirement that way. The reality when we actually retire, what they did is they went and surveyed 5 million retirees and they looked at their numbers, they looked at their books, they looked at their budgets. Here's how it happens in real life, regardless of your income and your retirement and your net worth. For the 5 years that directly surround our retirement, when we stop actively working, whether forced to or chose to, the 2.5 years before and 2.5 years after we retire, our budget goes up about 30%. So you have to be prepared, have some cash on the sidelines, whatever the case is, so you don't, you know, wreck yourself before you check yourself. But at the end of the day, we know we're gonna have a 30% bump. It's house remodeling we're gonna retire into. It's that trip to Italy for Jeff Bezos' wedding we've always wanted to go to. It's all those things we've dreamed about doing and haven't been doing. And our budgets go up 30% in that 5-year period. Now, not all, but up to 30%. But then something interesting happens. For the next 10 years, we have about 1% inflation. For the next 20 years, we have zero increased spending, nominally, meaning we spend less the older we get. So when you're doing a real retirement planning, just keep in mind, you're going to have a lot less expenses in your slow-go years from 75 to heaven than you do in your go-go years from 62 to 74, than you do in your active years from 30 to 62, right? You're gonna have, your expenses are gonna go down. Number one is your biggest expense ever is your income taxes. That will go away when you stop working. Your next biggest expense is your mortgage. That goes away when you pay it off, right? So your expenses are gonna drop precipitously as you age. So having a great financial plan, having a plan at all is really important. All right, any other questions, comments, thoughts?
Coastal office, luxury, PV, you guys are too quiet. It's, come on. Mark has a great smile for you.
I have a question.
Okay.
Regarding the $500,000 for couple, they have not changed that for many years.
Yeah.
And with the inflation, you would think it's about time that they should have done something with that.
Yeah.
There's nothing like that in the big, beautiful bill, is there?
So it was suggested and almost immediately ruled out. And I could tell you that if you go Google, I think it was Bill Pulte from Pulte Homes that was recently interviewed on this, did a great interview on it. But yes, 250 single, 500 married, it should be at least double that right now. And the challenge is for us as real estate agents, we want that to be raised because there are people out there who are not selling. My father-in-law is a real estate agent, and he just had a client who was seriously considering not selling because they had a couple million in gains on their property and they didn't want to pay taxes on it. So people are not moving because of that. So it's a big deal. I think over time it will get corrected. What you're seeing right now is state by state. I know Florida just put a cap on what taxes you'd have to pay above that exclusion. Tennessee just came out with something similar. So state by state, they're trying to help out from a state tax perspective, but you're absolutely right. 500,000 is not enough. It's not what it used to be, right?
Right, thank you.
Question, KW Coastal, I have a question. So the mortgage interest deduction, which is currently at a 750 max, is that going to change in the new bill?
So it's not suggested to change. What they're adding in though is writing off your interest on your vehicles. So the argument is, we'll help people by writing off their car payments. Well, my argument is I tell people don't have car payments. So yeah, there was a debate on that. We will see what it turns into. The way I would describe how this vote's going real quick, just as a side note, is you clearly have two different viewpoints of how we should spend our money and how we should make our money. So unfortunately, like if this were a marriage and the Republicans were married to the Democrats, it would have ended in divorce. I think we could all agree on that. But at the end of the day, you've got one side that wants to bring in more revenue by raising taxes. And then we want to spend that money on more social services, be more dependent on the government. On the other side, you want to cut taxes so that you spur on growth and build businesses, and you want to be less dependent on the government. What happens in all these bills is we end up meeting in the middle, and we end up with the most mediocre version of what was a good idea on either side. And so what you're seeing right now is you're going to have to, I'll bet you a steak dinner, they'll end up giving on raising any kind of, tax cap for selling your personal residence. So that won't change, I would bet you. I'll bet you the mortgage interest deduction doesn't go up. They'll give on that, right? There's going to be give and take from different places. I will bet you that SALT ends up, they modify it somehow, some way. Maybe they give 50% credit to your state and local taxes. I don't know what that'll end up being. But by the time we're done, it'll be next week, I believe. And I'm happy to come back in a month and talk about, what actually happened versus what's suggested. But at the end of the day, what's not going to change is accelerated depreciation, extension of the tax brackets, making that permanent, letting businesses actually project what their expenses are going to be based on permanent tax brackets. What's not going to change is QBI or deductions for investing in your businesses. They want you to invest back in your businesses. They want you to invest in growth. That's how we get our GDP to grow. So let's see. I'll bet you'll hear a fight over the MAGA named account just because it's named a MAGA account. That's the $1,000 per baby. So there will be a fight over that just because it says MAGA in the title, if there's not already. The extended business loss limitation. This is a big one. If you're later in your career and you want to prepare to sell your business someday, you need to know about the excess business loss limitation, because it will help you plan on maximizing your sales price without maximizing your tax bill. It's a whole different story. It takes a long time to go through that one, but let's see, anything that I missed here that you need to know about? It's probably the highlights, the same old Augusta rule strategy, the same old, accountable plan is a big deal. So if you're writing off a home office right now, and then you go sell your house, you have to pay recapture tax on whatever you wrote off against your home office. However, if you instead follow the accountable plan, ask your accountant about this, you can invest the same amount of money and rent a room out of your house for your office and never have to pay it back. It sounds like semantics, but it's not. It's part of this 179, raising the limits of investing back in your business. So go ask your accountant about the accountable plan. If they don't know what that is, find a new accountant. Anything else?
I got some. Rob Feldman from Coastal, KW Coastal. How you doing? You said you didn't want to get political, but and while I appreciate these are fabulous numbers, these are great numbers. My wife and I are on the end of our career after 32 years, and I'll be 73 this year. Blah blah blah.
Oh,
but $1,000 babies doesn't affect me. I don't want to talk about that. I want nothing to do with it. This big, beautiful bill, I think it stinks. I think the whole thing is bad. And I don't have the information like you do. You're amazing. You've got great statistics, and I applaud that. But I'm in the philanthropic world, which is absolutely devastated, absolutely going to take everything away from us. That's number one. If you want to get I don't want to get political, but there's so much that's going on, and you wonder why people are staying on the sidelines.
Gotcha.
I would, we're in Southern California, which all our group is here. And what we're finding, I can't believe that I'm saying $1 million property sits on the market because somebody doesn't want to pay a $6,000 mortgage. I don't care whether they can afford it or not. And then maybe you can talk about this big, beautiful bill will add trillions of dollars of debt. And all the stuff that I've seen, I've even stopped watching the news and knowing all the numbers. So I'm sorry if I'm getting huffy.
No, you're fine.
But I think that, based on what's here is
Yeah.
I don't believe it's going to be settled next week. I don't believe they're going to solve it. And you're probably right. It'll get mediocre and because you are right. If you have to do Democrat, Republican, Democrats can do anything until they're blue in the face. They're not going to get anything.
Yeah.
Nothing.
Yeah. So let me address.
Thank you. I appreciate
Yeah,
it.
no, thank you. Number one, I love that we can just have the conversation, right? I love that you can have your opinion, I can have mine. They may not be in alignment, they may be in alignment. And I love that piece of it. So here's what I would tell you from my perspective. Again, I tend to be right in the middle. I think I tend to believe, there's 350 million people in the country, and it's hard for me to fathom that more than 5% are way over here and more than 5% are way over here. 90% of us are probably more similar than different. But here's what I've told everybody who's had on either side that's had a very direct opinion. We are not in control of how this bill ends up at this point. We were in control when we voted for the people to go into the different places that they went to, right? And so what I would ask is, whatever you're passionate about, get the word out and learn about this stuff. Now, I will tell you that there's a couple things that you made that sound a little more fatalistic than I would believe, and I could show you kind of the, it's back and forth. To be clear, both parties have absolutely effed up our debt. This is not a right thing or left thing, okay? Both have contributed.
Absolutely.
Yeah. But what happens is every time, like I'll just pick on the right for a second. Trump campaigned on fixing national debt and spending and Doge and all those things. And now his actions are not lining up with that yet, right? So that's a problem. But so did Obama back in the day, right? Clinton was the last president who balanced our budget. And if your kid who's 40 something years old was bringing in $50,000 a year and spending 70, you'd pull them aside and say, one of two things has to change. You have to make more money or you have to spend less. That's our only options. And yet neither party is willing to take on that fight. So yes, will it add trillions? I think there's a path this adds trillions to our national debt. If you look at the reason I use 50,000 and 70,000, we bring in about $5 trillion a year in tax revenue right now. We spend about $7 trillion, $2 trillion deficit. Now, trillion's a massive number. But if you think about where those $5 trillion go to, one goes to paying our interest on our national debt. 1 trillion goes to defense, right? 2 trillion go to all of the other entitlements combined, and we have Social Security and Medicaid and all that stuff. And then the last trillion is what we have to run our entire country. So unfortunately, it's such a big business, the US government, we can't just go drive for Uber and make a couple extra trillion and pay off our debts, right? But at the end of the day, here's the bet that the one side is making, is that the only way out of this 5 trillion versus 7 trillion is to grow the economy, is to grow our GDP. And that will actually increase our tax base. There are lots of studies that show when you grow as an economy, your taxes go way up. But here's the problem we have, whether you're on the right or the left, our government's never found an extra dollar they don't like to spend. They just can't agree on what to spend it on. So, even the words big, beautiful bill, I think I jokingly with somebody said, this will probably end up being a small, mediocre bill when it's all fought over. But for us in real estate, I will tell you, depending on where you are, all of these things are advantages to real estate investors. It may be harmful for philanthropic type of entities. I haven't seen that. I haven't heard that, but I will look into that. I think the big thing is the more you study and the more I tend to try and take everybody's perspective and learn from it. But I will tell you, please don't hear this the way it sounds, but I've put thousands of hours into studying this. And then I'll get into an argument with a buddy from high school who's super MAGA or super left, who doesn't know what the flip they're talking about, making grandiose fatalistic statements. And that's where I tend to lose them. But I think all of us, we need to have these conversations. We need to study this. We need to be armed with this because your clients are likely going to align with the way you see the world, right? And if your clients believe the economy is going to hell in a handbasket, they're probably not looking to upgrade their house right now. So that's why I just try and hit people with the facts where they are, how it impacts them, et cetera. Okay. Yay. Any other politics? No.
No politics, just world stuff. It's always the more interesting. Other questions, other comments? Thanks, Dan. Good stuff.
We're good?
Yeah.
All right. Well, thank you very much for having me. I appreciate you. Hopefully you guys will go study a little bit of this and at least we will have clarity, hopefully in the next couple of weeks, whether it's passed or not, we'll see. But thank you all for being here. I really appreciate you. And if there's anything I can ever do to help, Minnie, you got my number.
Thank you so much, Mark.
Yeah. And the last remark, we are working with a lot of you to schedule you coming out into Southern California to have the full session, which is a must have. So we're going to talk soon again. Thank you so much.
Thank you.
I appreciate you guys. See you. Bye.
Awesome.
Bye. Thank you, Mark. Well, we're going great.
Okay, very informative.
Yeah. Any questions, any comments, any ahas between all the other locations that you guys want to share or just besides what Mark's session, anything else that you want to bring up in the whole group? We have the whole 4 offices on here.
I think, understanding the perspective of wealth is very important in how we deliver that. And the importance of what we do in real estate, right, to help our consumers on the long haul of it, right? The equity and the investments. And as Mark was, talking earlier about the importance of the graphs or where people typically stake and based on age as well. So I think that perspective was really, really good to hear from Mark.
Yeah, the age one made me feel like, all right, I'm doing okay.
Well, those median, median numbers,
The medians,
so,
yeah.
so I mean, you definitely want to completely excel over that because he told you, he shared the concept of how it works with the average basically. But definitely self-reflect like where I'm at, but then also when you have a conversation with prospective clients, then you want to know their financials, where they are, because you're going to help them to make a massive difference in their life, right? First time or continue to make that big impact. So you want to see where they fall, that area. So it's definitely going to change the type of conversation. What else?
Really interesting how only 9% of realtors own investment property. That's just interesting.
That's again?
That only 9% of realtors.
Yeah, okay, I said 90, right?
Yeah, not yet.
Yeah, only 9%.
I look
9%,
at
right?
deals every day, yeah.
Yeah.
First online for sure. I'm curious to hear from the other offices. Any feedback?
Yeah, Palos Verdes is very noisy today. You guys, Maureen, you need to behave. You too loud over there. Hegame, relax as well. Who else? Janet, come on, you got some stuff to say.
These are all good talking points for our agents to talk to their buyers and making the investment and purchasing real estate. All these potential, if the bill passes, it will be good talking points to encourage people to purchase homes or invest in real estate in general. So I think we should make classes about that. Anybody else?
Yeah.
Janet's gonna say something.
I think that it would be worthwhile to do like, even through AI, just kind of go through and do like a little one-page summary on some of the items that might affect investors. I have some investors right now and, just say, look, these are some of the things that we think are going to affect you. And you should talk to your tax professional about this. But, I think it's a good time to buy real estate.
Yeah,
Hope you want to add something.
yeah, that's a good point. No, I think Rob already claimed his 5 minutes fame. Mark is gonna call it later for sure.
I'm sure.
Yeah, and he always have to show off his age. You know, just show off. Thank you. Who else? Any other?
Thank
Well,
you, Chris.
Many, it's yes.
Many.
Yes.
Hello,
Yes.
hello.
Hi, this is the small satellite office here in the valley. This is Alon. I want to make a little comment. A little bird told me that Mr. Jerome Powell is going to be reducing the prime rate come September. It's a conversation to have with your clients, especially your buyers. Say, hey, let's not wait till the craziness happens come September. Let's buy now. There's more inventory. We can actually negotiate. And then the 2-1 buy down, I cannot emphasize how important that is. Talk to the buyers and tell them, hey, 2-1 buy down is available. We can get the house we want, the price we want, and we can get a interest rate that's 2% less than the market. And guess what? The seller is gonna pay for it. So that's something that I recommend for everybody to get knowledgeable about.
Yeah, absolutely. Good points. Thank you. Anybody else?
Maybe 3?
Yeah, Gary? Are you trying to say something?
Please. Or they will pet me. So.
Okay, that's Gary.
Good takeaway.
Take away.
Well, it's always got a great smile, that's for sure. Okay, everybody, thank you for your time. Thanks for showing up, and we'll see you at the next meeting.
Sir.
Thanks, everybody.
Awesome.
Thanks, May, for arranging this.
Many, one more thing.